Hello, and welcome back to Forex School from Pip Insight. This is our complete course on RSI and divergence, reading the momentum behind every move, so the chart stops being a flat picture and starts telling you how hard each side is actually pushing. Here is the roadmap. We begin with what momentum really is, and what the 14-period RSI genuinely computes, in plain English, no formulas required. Then we tackle the most expensive myth in indicator trading, overbought and oversold. From there we study divergence properly, regular bearish, regular bullish, and the hidden variety that argues for continuation. Then the ingredient most videos skip entirely, the structured trigger that turns divergence from a suspicion into a plan. And we close with an honest chapter on where all of this fails. Everything here is education, not financial advice. Notebook out. Let's begin. Let's define our subject before we try to measure it. Momentum is the speed of price change, not its direction. Two markets can both be rising, yet one climbs with huge, confident candles while the other crawls upward on shrinking bodies and hesitant wicks. Same direction, completely different momentum. Think of it like listening to a car's engine rather than watching the road. The car can still be rolling forward while the engine note tells you the driver has lifted off. Momentum usually fades before price turns, which is why traders study it at all. And here is the quiet truth of this whole course: every momentum indicator merely summarizes what the candles already show. So what is the relative strength index actually doing under the bonnet? Let's open it up, in plain English, with no algebra required. Strip away the mystique and RSI is a simple scoreboard. It looks back over the last 14 candles, that's the standard setting, and asks two questions. On the candles that closed higher, how big was the average gain? On the candles that closed lower, how big was the average loss? It then compares the two and squashes the answer onto a scale from 0 to 100. That is the whole machine. If the last 14 candles were mostly strong bullish bodies, gains dominate and the reading sits high, up into the 80s. If buying and selling were evenly matched, it hovers near 50. 14 candles, average gain against average loss, one number. Nothing about the future lives in there, only a summary of the recent past. That has a beautiful consequence. Because RSI is built entirely from closing prices, everything it knows is already sitting on your chart, inside the candles themselves. A run of large bodies in one direction is exactly what drives the reading towards an extreme. Shrinking bodies, overlapping ranges, and long rejection wicks are exactly what drag it back towards 50. So throughout this course our charts show pure price, and will train your eye to read the momentum straight off the bars, body size, wick length, and the ground each candle actually covers. If you can see effort and result in the candles, you can estimate what the RSI pane would say without ever drawing it. Now for the most expensive misunderstanding in all of indicator trading, what overbought actually means. The myth goes like this: when RSI rises above 70 the market is overbought, so it must fall; when it drops below 30 it is oversold, so it must rise. It sounds tidy, and in a strong trend it is a machine for losing money slowly. Overbought does not mean due to fall, it means the last 14 candles were dominated by buyers. In a powerful uptrend that condition is not a warning, it is the very definition of the trend, and the reading can sit above 70 for dozens of candles. Where the classic interpretation genuinely earns its keep is in a sideways range, where price really does swing from one extreme back to the other. Same number, opposite meanings, context decides. Here is the myth in action. This market opens near 126 and climbs almost 250 pips across 14 candles, 11 of them bullish. On a chart like this, RSI would cross above 70 within the first 3 candles and barely leave that zone again. Yet every single overbought reading was followed by more strength. The only pauses are the two soft candles marked as dips, closing at 126.62 and 127.90, each swallowed immediately by the next push higher. Watch the close marked BOS drive through the old high at 127.44, and the chart finishes at 128.44, still grinding upward. Traders selling each overbought reading here were not trading a signal, they were arguing with a trend that never blinked. Now the market where the old rule genuinely works. This one is going nowhere, a ceiling at 127.60, a floor at 127 exactly, and price rallying back and forth between them. Watch the touches. The third candle tags the ceiling and closes back at 127.48. The sixth candle touches the floor and buyers respond at once. The ninth candle, marked sweep, pokes a single pip above the ceiling and then closes back inside at 127.46, trapping the breakout buyers. And the 12th dips a pip beneath the floor before closing back at 127.10. In a range like this, momentum truly swings from one extreme to the other, and readings near 70 and 30 line up with the turns. Mean reversion lives here, and, for the most part, only here. Now we can define divergence properly, because you understand what the indicator measures. Regular bearish divergence is a disagreement at the highs, price prints a higher high, but momentum prints a lower high. Translated into plain candle language, the second push reached further in price, yet it got there on smaller bodies, slower progress, and more rejection from above. More result, less effort. Regular bullish divergence is the exact mirror at the lows. Price makes a lower low while momentum makes a higher low, because the second decline carried far less force than the first. Divergence is the market comparing effort against result, and it warns of fatigue. What it does not do, ever, is time the turn by itself. Here is the pattern this whole course orbits. The first leg is real strength, for grinding candles with bodies near 20 pips each, then a fifth that drives to 127.48, the level marked high one. Price pulls back to 127.06, and the second push begins. Now watch the candles confess. It takes 4 bars to regain the same ground, and the bodies shrink as they climb, 12 pips, then 8, then 6, then 4, while the upper wicks stretch from 6 pips out to 12. The final bar noses to 127.54, a higher high by just 6 pips, but an RSI pane below this chart would print an obvious lower high. Price says HH, momentum says LH. That disagreement is regular bearish divergence, and the heavy candles that follow, closing at 126.90, show why it earns respect. And the mirror image at the lows. 5 heavy sell candles drive into 126.94, the level marked low one, with real force behind them, bodies close to 20 pips. The bounce reaches 127.36, then the sellers try again. But look closely at the second decline, bodies of 10, 8, and 6 pips, with lower wicks stretching out to 16 as buyers absorb every probe. The push bottoms at 126.90, a lower low in price by just 4 pips, achieved on a fraction of the original effort. Price says LL, momentum says HL, regular bullish divergence. And notice the confirmation, the candle marked BOS closes at 127.38, through the bounce high, and the chart climbs away to finish at 127.68. Regular divergence hints at reversal. Its lesser-known sibling, hidden divergence, argues for continuation, and in a trending market it is often the more useful of the two. In an uptrend it looks like this, price holds a higher low, but momentum plunges to a lower low. Read that carefully. The pullback was violent, fast candles, big bodies, momentum badly dented, yet for all that force, the sellers could not even reach the previous price low. Enormous effort, feeble result. That is the signature of strong demand sitting beneath the market. The downtrend mirror, price prints a lower high while momentum makes a higher high. Regular divergence warns the trend is tiring, hidden divergence suggests the trend is defending itself. Watch the idea breathe. This uptrend's first pullback is polite, 2 candles with bodies of 10 and 8 pips, easing down to 127.30, the level marked first low. The rally that follows reaches 127.98. Then comes the second pullback, and it is anything but polite, bodies of 28 and 20 pips, roughly 3 times the size, the kind of drop that would slam RSI to a lower low than the first dip ever printed. Now the punchline, at the arrow marked higher low. For all that violence, price stops at 127.38, 8 pips above the old low. Momentum made a lower low, price refused to follow. That is hidden bullish divergence. The candle marked BOS then closes at 128.12, above the old high, and the trend resumes as if the storm never happened. Divergence on its own is a suspicion. Here is the ingredient that turns a suspicion into a plan. Here is the problem with trading divergence naked: it has nothing of its own to lean on. It defines no entry, no invalidation, and, as the honest chapter will show, it can persist against a trend for a very long time. The fix is to pair it with structure. Between the two highs of a bearish divergence sits a swing low, the floor of the pullback. That level is the trigger. While price holds above it, the uptrend is structurally intact and the divergence remains only a suspicion. A decisive close through it is the moment price finally agrees with momentum, a genuine break of structure. No break, no trade. A fading trend can still keep rising for far longer than anyone expects. Let's build the full worked example, an illustration for education, not a recommendation. The rally into 128.88 is impulsive, and the pullback that follows bottoms at 128.46. Mark that level immediately, it is the future trigger. Now the second push. For candles with bodies of 14, 10, 6, and 4 pips, upper wicks growing the whole way, finally nosing to 128.98, the point marked high 2. A higher high in price, an unmistakable fade in momentum, the divergence is on. But be honest about what the chart shows at this exact moment: a market still printing higher highs. Traders using this framework would do precisely nothing yet, except watch 128.46 like a hawk. Same chart, the resolution. From the fading high, 2 bearish candles roll price back down, and then the moment arrives. The candle marked BOS closes at 128.34, decisively through the trigger at 128.46. Now, and only now, momentum and structure agree. Watch what happens next, because it is the pattern from our very first course. The following candle rallies to 128.50, tags the underside of the broken level, the bar marked retest, and fails, closing back at 128.40. Old support, new resistance. The decline that follows reaches 128.08. Every element was defined in advance: the divergence gave the warning, the level gave the trigger, the retest gave the second look, and a push back above high 2 would have ended the idea entirely. Before the recap, the chapter most channels quietly leave out: where divergence fails, and for how long. Let's be straight about the weaknesses. In a strong trend, divergence can stack against the move for weeks. A relentless uptrend can print 3, 4, 5 successive bearish divergences, each one looking exactly like the textbook, while price adds hundreds of pips. Anyone fading each signal would have been run over repeatedly, and that is not rare, it is normal behavior for trending markets, which is precisely why the trigger chapter exists. So file divergence where it belongs: it is context, not a signal. It tells you the engine is straining, it does not tell you when the car stops. Treat it as a reason to pay closer attention and tighten your levels, never as a standalone reason to act. And before trusting it with real money, journal a large sample on your own market and time frame. Trading carries a substantial risk of loss, and most retail traders lose money. Let's gather the whole course onto one page. Momentum is the speed of price change, and RSI is simply a 14-candle scoreboard, average gain against average loss, squashed onto a scale from 0 to 100. Overbought means recent strength and nothing more. In a trend it is a continuation signature, and only in a range does mean reversion at the extremes reliably earn its keep. Regular divergence is effort disagreeing with result, a higher high in price on a lower high in momentum, or the mirror at the lows, and you can see it in shrinking bodies and lengthening wicks. Hidden divergence flips the logic and argues for continuation. None of it becomes a plan until structure agrees, which means a real close through the trigger level between the swings. And the honest truth underneath it all: divergence is context, not a signal, and it can lean against a strong trend for weeks. And that completes the RSI and divergence course. You can now read momentum straight off the candles: body size, wick length, ground covered, estimate what the indicator would say without drawing it, spot both regular and hidden divergence, and, most importantly, refuse to act on either until a structured trigger confirms the story. Your homework: open any chart, find one bearish divergence, and mark the swing low between its two highs before peeking at what happened next. If this course sharpened your reading, subscribe and turn on notifications, because the next Forex School course is already on its way, and the full playlist will take you the rest of the journey. One final reminder: everything in this series is education, not financial advice. No method is a promise of profit, and trading carries a real risk of loss. Practice on a demo account first. Until next time, happy studying.